Okay, so let's have a look at part 3 for Henry 2021 flexible budgeting question that can come up in section 3. So it says prepare a flexible budget for 90% activity level using the margin costing principles and show the contribution. So your margin constant or your marginal costing principle is usually sales less your variable costs. Now we know in this question that we've got variable cost of production overheads and other overheads because we separated them in part 1 and 2. But also direct materials and direct wages are also variable costs. So we need to calculate how much they are per unit. So sales, marginal costing is your sales, that's your variable cost. Now your variable cost is made up of direct wages, direct material first. Direct wages. It's made of production overheads. And it's made up of your other overheads. So when we take your variable cost away from your sales, you're going to get contribution. And they've asked for that in the question. And then from that then you're going to take away your fixed costs. And we know from the question that we've got administration is going to be fixed. And from part 1 we've got production overheads is also fixed. And from part 2 you've got your other overheads is also fixed. And that's going to give you a profit. So that's your marginal costing principles. So we're asked to do this at 90% capacity. So if it's 90% capacity, then we're going to take any of these output level units. You can take 55%, 75% or 95%. And now what we're going to do is find what is 90%. So we know that 95% is equal to 47,500. So 1% is equal to 47,500. Divide that by 95. And then we're looking for 90% then, as per the question. So 90% is equal to 500. Multiply that by 90. So looking at 45,000 units are going to be produced at 90%. So what we can do now is we can fill in the information that we know from the previous question. So we've got our production overheads. So your production overheads are €4.40 per unit for your variable costs. So production overheads, we're going to do a calculation of €4.40, multiply that by 45,000 units. Our other overheads then, from part A, is going to be €5.25. So we're going to take €5.25 and we're going to multiply that by 45,000 units because that's how many units we're going to produce. We know that our administration costs, we can just put the figure in as per the question, is going to be 38,500. Your production overheads then we're going to calculate, we've that calculated already. Fixed production overhead is 8,000. And then our other overheads, which is also calculated in part A, 6,500. So all we have to do is find what is the variable cost for our direct materials and our direct wages. And remember, we're going to use the high-low method like we did in part A to calculate those two figures. So we've got our direct materials and our direct labor. We're looking for a variable cost. We're going to use the high-low and we're going to get the difference between the units and the money or the revenue we got that we need to pay for that. And then we're going to divide one into the other to find out what is the variable cost per unit. So we know that our high in units is 47,500. Our low in units then is going to be 27,500. For our direct materials, our high is going to be 261,250 and our low costs are going to be For direct materials, 151,250. So then you're going to divide the 20,000 into the 110,000, and the variable cost per unit for direct materials is €5.50. So we're going to do a calculation, €5.50, multiply that by 45,000. Then we do the same then for direct wages. So we know that our high is 47,500. We know our low is 27,500. And then the cost then for direct wages for our high is 318,250. And for our low then is 184,250. So same again, divide the 20,000 into the difference of 134,000, and we'll get €6.70 for our variable cost per unit. So we're going to do a calculation, €6.70, multiply that by 45. So materials cost €5.50, multiply that by 45,000. We got €6.75, multiply that by 45,000. Got €4.40, multiply that by 45,000. And we got €5.25, multiply that by 45,000. Now we're going to add up all the figures for your variable cost. And that's going to give us 983,225. I'm going to do the same then for your fixed costs. And you get 53,000. So it tells us that profit is budgeted to be 20% of sales. All units produced are sold. So that means your profit is going to be 20%. Your sales is always 100%. So that means that these two figures are going to make up 80%. So if this is 80%, so 80% is equal to 983,220 plus 53,000. So 80% is equal to that. So 1,036,225. And 100 or 1% is going to be equal to 103,650 divided by 80. So then 100%, which is your sales figure, is equal to 12953.1 multiplied by 100. So that's your sales figure. So you can put that in for your sales up here. And now you can find your contribution. So your contribution is sales minus your variable costs. And then your profit then is your fixed costs minus your contribution. Remember to show your figures to two places of decimal, so there's a bit of decimals in this one. So our profit is 259,062.50. So remember for your marginal costing, so your marginal costing is your sales minus your variable costs minus your fixed costs. Remember, we'll have items to make up your variable cost depending on the question. So direct materials is going to be variable cost, direct wages is going to be variable cost because it depends on how much units we're producing will result in how much material we're going to need to produce that and how much wages we're going to need in manpower. Production overheads and other overheads, we know they're variable because of the question itself. And then your fixed cost then, so you've got administration, and then we've got the fixed cost from part 1 and 2, which are your production overheads and your other overheads. So you get all those figures and we add the two of them together. They're going to make up 80%. So your total variable costs and your total fixed costs make up 80%. So if you know what 80% is, then you can calculate what is your 100%. That's going to help you calculate your contribution because you need that for the question. And then your fixed cost takeaway contribution will give you your profit. And that's part 3 answer. Now this will use this when we look at part B for option 1 and for option 2. We'll be just adjusting these figures here depending on the scenario they've given us. But that's part A3 for Henry 2021 flexible budgeting question.